at it.
There we go.
I guess we'll start. Okay. Hi, everyone. I'm back here with Philip Petursson again, our Chief Investment Officer at IG Wealth, and also manages a large team that is helping oversee the overview of your portfolios and also the direction of the portfolios and the correcting that happens over time. I wanted to touch base again with Philip as soon as possible after our last meeting. And Philip, first of all, I know how crazy busy you are, and I really wanted to thank you again for your time. I so appreciate it.
Rod, it's my great pleasure to be here speaking to you again today, and very happy to get the message out.
Yeah. There's really two things I wanted to touch base on today, which I alluded to in our last video, and which, by the way, I get tremendous feedback from all of our clients that are watching. I hear that it adds a different level of insight, and it's nice to hear it from, no disrespect, the horse's mouth.
None taken at all.
Yeah. You knew I'd get that in. Hey?
Yeah, absolutely.
But so the first thing I wanted to touch on, because is volatility that is currently happening in the marketplace, because I'm hearing from clients a lot about how there's excess volatility, and it's volatility that's very uncomfortable. And I'd like to get your interpretation of the volatility and where we're at today.
Certainly. Well, it's really interesting. When we think about volatility, we tend to only think about it in one direction, and that's when the markets are down. But in truth, volatility works in both directions, to the upside and to the downside. What we've seen recently in terms of the market volatility, that many clients will say to me, I've never seen it this volatile, or it's extremely volatile. When is it going to end? The truth of the matter is that the volatility that we've seen really since the end of July into August, September, and even now into October is actually quite normal. It isn't, if you compare what we've gone through over the last, say, 6 to 8 weeks versus the last 20 years, again, it's very, very normal. And so I think what changes the perception is this 24-hour news cycle that we have, where you'll hear about it nonstop. And just to give you an example, I was listening to one of the US broadcasters, and they said, for I think it was last week, well, the market, has seen the greatest downturn since Wednesday. And, that's how they're phrasing it. It's not, the greatest downturn in 20 years. It's, well, we've seen the markets down greater than what we saw 2 days ago. Well, how was it 2 days ago? Well, not so bad. How is it today? Not so bad. But they're making it sound like we're seeing extreme volatility out there, when, again, in truth, this is all very normal.
Yeah, thank you, Phil. One of the things that I was very much aware of and spoke with clients as much as I could is that one of the things that was very unusual was actually the lack of volatility over quite a period of time. And I really think it's, coming back almost out of the 2008 Great Recession, with the feeding of the economies, of course, with free money and, low interest rates. I thought what was very unusual was the lack of volatility. But when I personally look at all of the numbers and the volatility ratings today, to your point, they actually are falling right in line with actual normal averages.
Exactly. And that's the thing. When we look at the changes in the market and the volatility, is it out of the norm? Well, if we go back to February and March of 2020, yes, that was extreme. You were seeing drops in the market of more than 5% on any given day. In fact, I think there was one day where the market had moved up and down and back up by 11%. That is unusual volatility. What we've seen here, if we look at the S&P 500, for example, from the top of the near term, which was July 31st, to where we are today, yes, the markets are down about 8%, but that's not even a correction. A correction is the market being down more than 10% and less than 20%, which, by the way, tends to happen every other year. We haven't really seen that since, we saw it last year, actually. But this volatility, again, is right in what we would call normal market activity, and really nothing out of the ordinary.
Yeah, and so the other thing that I'm often hearing from clients at this time too is the term, of course, the R word, which I'm surprised they're still talking about it, because it's been about 18 months or more in the news cycle. And I love how you always talk about it, how the R word, recession is what I'm talking about, of course, is that, R's come in different sizes, right? There's the big R, right? There's the little R's, and there's the ones in between, kind of like the porridge and the three bears. And when you're talking about recessions and market activity, there's very much a correlation as far as business activity, but the markets are so future looking. I'd like you to talk a little bit about why recessions and markets do not necessarily work hand in hand, particularly over the long run.
Certainly, what you typically see in a recessionary environment is that there are signs that it's coming, whether it be an inverted yield curve, weaker manufacturing, weaker housing markets. There are a number of signs that we pay attention to that give us a sense that we're approaching a recession. They don't time it and saying, hey, November 30th, this is when it's going to happen. But you can see the pressure build. With the markets being a forward looking mechanism, investors tend to say price this in, that's how we phrase it, but price in the recession before it happens. So you tend to see the peak in the equity markets in advance of the recession starting, and then the bottom of the equity markets, or the sell-off, ending usually about halfway through the recession. So now you're starting to price in or factor in a recovery. And the market, if you wait for the recession to be over, well, you could miss half of the recovery at times. And so what we've seen right now, Rod, actually is very interesting because, as you mentioned, we referred to it sometimes as a little r or a big R. This one I actually almost would say is a footnote of it in the United States, because we've seen recessionary pressures over the last, say, year to 16 months, and now some of them are starting to dissipate. Some of them are actually indicating that the worst of the economic slowdown is actually behind us and not in front of us. And so this has been, to use it almost like a culinary comparison, a deconstructed recession where we've seen it in parts of the US economy. In fact, some of those parts are actually starting to show recovery.
Interesting. Yeah, really interesting. And and what I think is amazing is when you tie that in, the thing about a recession is it is a backward looking instrument, meaning time has to go by before a recession is even declared. They say, oh, you know what? We were actually in a recession 3, 5, 6 months ago. Right? And so, and again, why investors often miss, of course, or wonder why markets may be rising when in fact they hear that we're in a recession, is because you don't know you're in a recession when you're in a recession until it's at typically the very end, correct?
Exactly. And that's what we saw in 2021, actually. We had a very short recession in the United States between March and November. Sorry, not 2021, 2001. We had a recession between March and November of 2001 that we were told existed first quarter 2022. And it was like, oh, by the way, the US economy went through a recession, but don't worry, we're actually already through it. And I think, again, while I don't think what we've gone through is going to be officially called a recession by the National Bureau of Economic Research in the United States, I think we can recognize that elements of it have come and gone.
Yeah, again, very interesting. Thank you. Very timely. Another part of this, when I talk about volatility and recessions, is that, and we've spent a fair bit of time talking about this independently, is that, globalization, of course, but there was a unique event for a long period of time where really it seemed like all major economies of the world were either rising at the same time or slowing at the same time, which really it's a very unique thing because again, why would Europe be rising the same time as China, right, et cetera? I mean, and there is links now, but you know what I mean. There's typically always been, with the use of diversification, the opportunity to pick up yield gains and future pricing and future growth through that diversification. Can you just touch on that base today?
Yeah, certainly. And I think it's even more important today than what we've seen because in the last couple of years since COVID, we have actually seen almost a deglobalization or a de-emphasis of companies to be too dependent on one area of the world for their exports, meaning China. We saw it through the COVID lockdowns where many parts of China were shut down and companies that were solely dependent on China for their manufacturing, they struggled to meet any kind of demand because they just couldn't get the supply. So we're starting to hear and see companies diversify their manufacturing base. And this is creating actually interesting changes in the global economy. So Rod, to your point, there was a time when it was almost like the whole world went through expansion or recession all at the same time. When I just finished talking about what we're seeing in the US, how it looks like the US might be coming out of some of its recessionary conditions, we can argue that Canada is just starting to see recessionary pressures, as a result of higher interest rates, whereas Europe is probably somewhere in the middle. And so when you figure that out, or when you factor that into stock market valuations and positionings, it does force you to think about the upside potential of each market. Now, the markets aren't going to be correlated or move all in the same direction because their economic cycles aren't moving all in the same direction. So this is driving us to put a kind of focused lens on the opportunity set in the United States versus Canada, and oil prices and the banks versus Europe and its ties to China. And so we're seeing more potential and differences in potential asset class by asset class. And that's where it comes into diversification. Now, we never have the perfect vision on this to say, oh, this asset class is going to outperform all others, therefore own it. But you do have to be respectful of the changing opportunity set across asset classes to properly take advantage of that.
Yeah, I thank you very much for that explanation, because the news cycle, again, as you say, as Canada is, if they are now slowing and heading into that recessionary period, again, as you say, a footnote, not say a big R. But with that, the news cycle will certainly be reporting a lot of negativity. And I think it's really important for our clients to know two things. One is that we diversify globally for all of the reasons that you've talked about. And what you've told me, of course, is that there's great opportunity when we have to look globally because of things like Europe, midpoint or starting to come out of recessions, et cetera. Right? So, but the other part of that too is something that we've been introducing into our portfolios for a while now. And it's a term that people are going to hear more and more of, and I do talk about it, but the term is called alternatives. And alternatives are used for many reasons, and I'll let you talk about that. But I'd like for you to talk about why, first of all, alternatives are so important to retail investors and why they haven't had access before.
Certainly. And let's go back in terms of what isn't an alternative, or what is the typical investment asset class or universes. And it's really comes down to stocks, public ownership of companies, bonds, whether it's corporate bonds or government bonds, and then cash. So those are typically what we think of the building blocks to a portfolio. Then comes in alternatives. And why are they called alternatives? Because they're alternatives to the typical asset classes. Now, there's a big bucket of what these things can be, but largely let's just focus on two or three. One is private equity. So now it's ownership in private companies that you can't buy on the Toronto Stock Exchange or the New York Stock Exchange and so on, or private debt, where you are, we as a company are lending companies money for their business operations, and that debt isn't traded on the open market. The advantage to some of this is that historically the returns out of private equity or private debt are superior to what you can find in the public markets. And the second advantage is that you don't see the volatility in the same way, because you don't see that daily mark to market. And I think it was Warren Buffett or Ben Graham who said, look, day by day, the market is a voting machine. I love Microsoft. I hate Microsoft. I'm about Microsoft, and that's reflected in the price. But over the long term, it's a weighing machine where the valuation of that company really doesn't change that much, aside from what the value, how that value grows based on its business. And so when you remove that mark to market, it allows us to have more patience with these private companies, and to benefit from their long-term growth without having to come to the table every single quarter and explain why their earnings were off by a penny based on what analysts expected. And so it delivers, one, less volatility over time, and two, it's intended, and what we've seen historically is that these asset classes deliver superior returns.
Yeah, now interesting. It's always been, if I could talk about Canada Pension Plan, which is really, Canada's largest pension, and, massive asset pool. And, Canada Pension Plan for decades has been utilizing the idea of alternatives, particularly in the private credit, private debt, like you talked about, private equity. And that made up a relative sliver, of course, of the portfolios. But when we look at it today, alternatives actually make up a very large piece of the overall portfolio, because nobody cares more about longevity of income and reduced volatility, in my mind, than likely the Canada Pension Plan. And because of their scope and size, they have had access. And most pensions have had access to types of investments retail investors just simply haven't. So I'm going to let you tell the story.
Right. Well, that's exactly it. First off, is that Canada Pension Plan with effectively an infinite time horizon. As long as there are Canadians, they will have future liabilities to have to pay out. So private debt or private equity works very well for them because they have a long-term time horizon that they can allow these investments to mature over time and deliver the returns that we hope they'll deliver. And on the in terms of the availability of this, it had been up until recently really only available to the large pension plans. And it wasn't geared towards our clients, but that's changed over the last few years. And in particular, IGM, our parent company, has taken an ownership stake in one of the larger private equity and private debt managers in Canada that actually manage some of CPP's money to the benefit of our clients. And so incrementally over the last number of years, we've been increasing our investment in private equity and private debt through this company, this management company that has a very long-term track record of success in these areas, and continues to find opportunities that, in fact, we're right in line with CPP on many of these deals, which is access that if we didn't have the size that we did, we wouldn't be able to make that transaction and provide that benefit to our clients. But thankfully, Rod, we are sizable. We do have the backing of a very successful organization to do this.
Yeah, it's wonderful. It's such a competitive advantage in my mind, because if I were to ask any client, say, define me your ideal portfolio depending on your risk profile, and they would say, well, I want the best possible rate of return, but I want the least amount of risk. And the whole idea of private credit and private debt, or sorry, private equity and private credit, is to do that. It's to not only help reduce volatility, but also to enhance overall long-term returns. And I'm so grateful that we have that, and that we have been implementing this into all of our portfolios, and that it really is starting to shine, particularly as the volatility is increasing throughout the calendar year. I can really see those slivers and why we're expanding them within the portfolio.
Yeah, and one thing to note as well is that immediately the question might come saying, well, if this is such a great investment with lower volatility and higher returns, why don't we put all of our money into it? And the answer is, well, we simply can't. There aren't enough quality deals out there in order to satisfy that. And that's why it's very, very important who we partner with. You don't want to just partner with a company that doesn't have the network, doesn't have the connections, and doesn't have the capital to basically attract the higher quality deals. But two, in doing these deals or in committing this capital, you're committing to it for a longer period of time. Remember, CPP will enter into some of these private equity deals where the exit strategy is 10 plus years away. So you are giving up or sacrificing liquidity for this. We are committing a portion of our capital over the long term into these strategies that we think is prudent, right, in line with our client objectives, where they do have a time horizon of 30 years, some a little less, some a little bit more, but ultimately we have a time horizon. So we're willing to accept some of that illiquidity of the investment for those greater returns and manage that weight within the context of an overall portfolio.
Yeah, it's wonderful. It really is. I say very grateful for IGM, right, and the massive amount of capital that they have, and also their relationships. Now having relationships and including companies like Rockefeller as an example into also the portfolios, in which we continue to do all the time. Clients, unfortunately, I don't think actually know that we're doing this until maybe like I tell them. So that's something as a takeaway. I think maybe we could do a better job of that. Okay. But what I wanted to do also was I just want to do a quick recap, Philip, because I know that you're very busy. But first of all, volatility is normal, right? I think that's a real great takeaway, right? And that we're currently in a normal market environment. Secondly, and I will remember this, is that when it comes to recessions, there's big R's and little R's. And in your case, what you talk about is really more of a footnote. And really where the economic cycles were happening around the world, and really where some economies are more advanced at this point in coming out of recessions, and others are really maybe just starting. And that because of the diversification globally, that really is something that is a competitive advantage as well for us as a company. Okay. And then, yeah, and then lastly is just that we're also have introduced and have been fortunate enough to introduce these ideas of private equity and private debt. And thank you very much for explaining what it is, and that we are continuing to introduce that within our portfolios and have been in a number of years. And it is helping reduce volatility, right? As well as increase overall returns, right? Did I get that right?
Yeah, absolutely. And I would say what we've seen right now is fairly normal. The headlines, Rod, can be quite scary in terms of what's going on in the Middle East and other areas around the world. And immediately we can turn our attention to the markets and saying, well, how is this impacting the stock market? How is this impacting my portfolio? We continue to say that, look, a lot of the geopolitical risk or events that occur over time rarely have a lasting or meaningful impact on our portfolios. And I would say that what's going on right now, while tragic, isn't having a meaningful impact on our portfolios because it doesn't change the profitability of companies. That's what we tend to focus on over time. It doesn't change the economic cycle. If it did, obviously we would take action. But for the time being, again a tragic event. It's a headline event, but it's not a market-driven event.
And for sure, it's very hard for clients to differentiate the isolation of those, right? Because as you say, one is a tragic event, and ultimately, economically, it doesn't affect, as an example, if somebody upgrades their iPhone.
Exactly.
Yeah. Well, Philip, I wanted to thank you very much again. And for all of the people that are watching this, I want to let you know, Philip is a regular guest and presenter on the Business News Network, BNN, as well. He does a podcast weekly with us. We have weekly commentaries that are heading out to you that are all written by Philip and his team. The communication is excellent. I'm very grateful for the time and the relationship that we've been able to build, Philip. I know our clients really enjoy this time. Thank you for the insights. And, I'll be bugging you again. Thank you.
Great pleasure, Rod. Thank you very much for having me.
You're welcome.